Good evening, ladies and gentlemen, and welcome to tonight's webinar. We're very excited to have you with us. Thank you for your time. We thought it was very important for us to be able to have this conversation in light of the rather hysterical mainstream media headlines as to what's going to be happening to property as a result of COVID-19. So we wanted to share with you some of the results from our independent panel of economic experts as to what actually has happened in property, what they believe is going to happen in property, and tonight we're actually going to show you which markets are fundamentally correct to be investing in and which ones aren't, and we'll actually have a live example of the type of property that we have been able to negotiate exclusively for our clients. With me here tonight is Adam Duffy, a partner at Meridian Australia, and myself, Warren Jacobs, the Senior Property Investment Consultant. So
great to be here. Thank you, Warren. Of course, we've got another webinar to add to the series here. It's been a nice and new way for us to communicate to our clients. And obviously, there's a bit more data and information that we can now report on again. So yeah, like Warren said, we'd like to look at what's happened over the last 3 months, what's forecast to happen moving forward, and have a look at what type of market we'd be attracted to in a time like this. Okay.
Yep. The disclaimer, we have to obviously mention this is very generic information. You will get an opportunity later on in this webinar should you want, obviously, for us to be able to discuss your own personal circumstances, but please don't run out and go buy a property in terms of what we hear from us here tonight.
Exactly right.
Okay, so as we said, what we're going to be talking about tonight, I beg your pardon, will be the performance over the past 3 months. Because when you have a look at what you're reading in the newspapers, you would think that property's fallen off the edge of the cliff. We also want to be able to share with you the analysis, as I mentioned before, from BIS Oxford Economics and SDS Economics, what the forecasts are for the property markets going forward. We also want to be able to, as I said, how to identify a strong property market, because there will be some weak property markets and there will be some strong property markets. And then right at the end, we will give you an exclusive property opportunity that we've been able to secure exclusively for our clients.
Okay.
So how has the property performed over the past 3 months? I mean, if you're listening to the news, you would see predictions and forecasts. Property's fallen 32%. Some say 20%. So how has it actually performed? Let's have a look at it. There is no question that in terms of sales volumes, there would have been a massive decline. In fact, we're looking at a 40% decline. Generally speaking, you'll find that those declines will be in line with what consumer sentiment is. And when we all heard about what was going down with the COVID-19, consumer confidence plummeted, no doubt. And in those circumstances, people are very reluctant to be selling their properties. And so you'll find that sales volumes have declined. And as we have said all along, the volumes will decline, but that shouldn't affect the value, which you will shortly see.
Yeah, that's what we've been saying for a good 3 months now. A decline in volume of sales and supply to the market was highly likely to be the result of such a severe drop in sentiment, which you can see here in this graph. For a long time, sentiment in the market, how people are feeling about things in regards to investment, typically correlates very closely to listings and transaction volumes that are actually occurring. So a massive drop in sales volumes. Look, it was a 40% decline over the month of April, which is just a phenomenally large decline in 1 month. And there's been that high correlation. So what's actually happened to consumer sentiment and how things have been occurring, how that's been tracking over the last few months is something that's important to monitor. You can see here that at the end of this graph, there was a big drop off in sentiment. Obviously, people were scared and uncertain about what to expect given COVID and how it was likely to impact our economy, how it was likely to impact the property market. But consumer confidence has been rising ever since. It obviously started at a very low point, but it's risen for 9 weeks in a row, and it's up 42% from where it was in March. Obviously, this is off the back of news of easing restrictions and low numbers of new reported cases. The curve, like we were talking about, needed to be flattened, and our government and things have been put in place that have really seen to flattening of that curve quickly as possible and to almost being non-existent as we speak here tonight.
Yeah, we're behaving as a country. We're behaving as in New Zealand. is actually now COVID-free,
Yeah.
and hopefully we'll be able to follow suit.
Yeah, exactly right. But this continuance in improvement in sentiment will certainly feed back into the market as well. So how have things been performing? Well, there's no signs of distress selling in the market at all. We haven't seen anything like that.
No, not at all. As we said originally, that you will find during these times of catastrophe crisis, people will hold on. So we're not seeing any distress selling in the market at all. And how has this affected rents, which is probably in terms of investment, has been the biggest question that we've had at Field.
No.
You'll see that as CoreLogic, as the slide shows you, has really only recorded a 0.4% of a decline right across Australia. And that's really led by Hobart, who are very heavily dependent on tourism and hospitality.
Yeah, exactly right.
So, and that again, that cuts across every market. Not good markets and bad markets. I know, we've got thousands of investors who were jumping up and down, obviously, when all of this happened, and we have fielded an insignificantly low number of people who have had any issues in terms of tenancy.
Yes, no, very true. So obviously certain markets more impacted than others. It's because the jobs have fallen by about 1/3 across accommodation and food services and arts and recreation services. So obviously markets that are fully or strongly reliant on these sectors of employment were going to have quite a big impact on rental prices. But overall, the impact on even rent hasn't been substantial at this point in time.
No, absolutely. And in fact, I was talking with Adam the other day about my son finding a place in Newtown. Probably one of the most desirable suburbs in Australia. It's Newtown in Sydney. But with 65% of the renters working in hospitality, there is going to be an effect in terms of the yield in Newtown.
Yeah,
there is.
One of the largest reliances on that hospitality sector in the country, isn't that? In the inner west of Sydney there. So yes, exactly. It's fed directly into impacting rental prices in that market. Yeah, certainly.
Absolutely.
Okay, so March to May. So how's the property market actually been performing? So there were some horrific forecasts and headlines there, obviously from banks that have got to do a wide variety of forecasts, and the media jumped onto their worst case scenarios and then blasted that out there to everyone. So what's actually been happening in the property market? Well, in March, the stock market started falling at the end of February, and through to March, the stock market, I believe, dropped 37%. So a substantial drop in the stock market. Property values remained very resilient. They actually grew 0.7% in March. In April, they remained resilient again. They grew 0.3%. And in May, remained quite resilient again, only dropping 0.4% there. So overall, you can see here, it's been quite a stable market overall. There's not substantial movements either way. It's just been an asset class that's been quite stable. The lack of volatility, these types of things, which is what we'd expect to see, and what we did expect to see, given not only a reduction in listings and a reduction in transactions, but so that's a substantial drop in supply that we saw. And typically, you'd see in anything where there's a big drop of supply, typically prices or values can increase in that time. But what coincided with the drop in supply was obviously a drop in consumer sentiment and a drop in demand as well. So you had both supply and demand reducing. We'd expect that to typically result in quite a stable result to prices, and that's what we've seen.
And the ability to actually get into a property and have a look, or even go to an auction, or go to a walkthrough. In March and April, that wasn't even possible.
No, that's right.
So, and yet still properties grew, and that's right across the board again. Not identifying that there are markets within markets within markets.
Exactly right. So this is how things looked over the month of March. You can see that 0.7% growth. It's quite widely spread across all of the capital cities here. The same thing for the 0.3% increase in April there. It's been quite spread across the cities. There was an interesting upwards movement here in Darwin. We're looking at this at 1.7% growth in the month was phenomenal. But what happened in May? Darwin lost 1.6% in the month. So overall, quite a volatile performance, but the same type of result, being quite stable overall. And again, it's quite the movements are quite spread across the cities at this point. So what are the reasons why property and housing has been so stable? Well, unlike shares, properties is liquid. It's got very high transactional costs of stamp duty and long settlement periods as well. It's obviously an expensive asset, be it purchasing a property compared to purchasing a share. Quite a big difference in what their overall value is. But one of the main reasons property is so resilient and quite stable historically, and why that's proven to be the case again here so far, is property is a consumption good. So it's less volatile, and there's relatively low investor ownership. So shares, for example, you look at it, obviously shares are 100% investor owned, whereas property across the country, it's only got an investor ownership of around 30%. The other 70% of dwellings, they're homes. They're people that are owning a home. That's their roof over their head. They're not trading or selling their property in times of distress like this. They're holding it.
Yeah, and sorry, mate. I also wanted to add that part of our own methodology is to ensure that we're in suburbs where owner occupiers are around about the 70% mark, because one will find that there is a negative impact into suburbs which are heavily weighted to investor stock.
Yeah, exactly. That might be the balance there across the nation, but there's certain suburbs where a good 60 or 70% of all the dwellings there are owned by investors. Now, in that kind of market, we'd expect to see much higher volatility in times like this and bad times generally, which is why you typically avoid investing in a market like that.
Absolutely.
Definitely.
So BIS Oxford Economics are part of our investor panel. They are probably the greatest or the biggest data collection agency on the planet. They really are, their expertise lies in forecasting what is going to be happening into the property market. And that is obviously something that is going to be of great interest to everybody. We've seen how it has performed in February, March, April and May while we've been going through the COVID, but how do BIS Oxford Economics see what the outlook is going to be going forward?
Yeah, so those that are familiar with Meridian's process will know that we're heavily reliant on our investor panel, which includes BIS Oxford Economics here, to really talk to us and explain what to expect from the markets moving forward. So it's great to look at what's happened, but what can we expect moving forward from the property markets based on this new environment, this new COVID environment that we're currently living in, and likely to be living in for the short term at least ahead of us. So what can we expect from the markets given where we've been at the moment? So they say that the direction of the housing market will depend on how quickly the economy can resume full-scale production, and the strength of the rebound has been enhanced by government interventions and earlier than expected lifting or relaxation of some of the social distancing policies. So what we've seen there is, I think for the majority of people, the flattening of the curve happened better than what we could have expected and what a lot of people were predicting. So we're already starting to see a wind back of some of those social distancing policies and whatnot that is certainly going to enhance the performance of the economy earlier than expected. We did see some scary kind of forecasts there from some investment banks, even like UBS investment bank. They've come out today and revised their forecast already, improved their forecast based on what they thought, based on these types of things here, government intervention and the winding back of the social distancing policies. I think that over the next 3 months or so, we'll start to see a lot more of that coming from the banks and other people that had some pretty pessimistic forecasts. But BIS Oxford Economics, what's their current forecast for all of the capital cities here? These are the forecasts. So prior to COVID, BIS Oxford had quite bullish forecast for all capital cities, especially Brisbane, Melbourne, and Sydney. They've revised that down, obviously. Based on COVID, things have flattened a little bit. So you can see here, for almost all of the markets, some are expected to lose a bit of value over the next kind of 6 months or so. Some are expected to remain quite flat. So they've said the recent strength in most capital cities is expected to go into reverse in the June quarter as the disruption from the coronavirus feeds through the property market. But in line with their macro economic outlook, they expect the drag to be temporary. Expect a stabilisation in quarter three, which has kind of been stable so far already, and expecting quite a strong rebound in quarter four. You can see here for all markets, especially Sydney, Melbourne, Brisbane, and Canberra there, the growth rate as we enter the end of 2020 and early 2021 is expected to be extremely strong.
Yeah, and also that slide goes across, as you've heard me say before, without trying to with monotonous regularity. That applies to all property.
Yeah.
So there will be some properties that will do a lot worse, and some properties that will do a lot better, and that's why to have a methodology that covers such extensive criteria to be in the top half of that as opposed to the bottom half, is very important.
Certainly market selection within the right market is very important. It's just looking at things from a city perspective, and we need to take it another level down than that. But it's good to see quite an accurate economic powerhouse here, and their forecasts moving forward are quite bullish. They're quite strong, and that'll be off the back of dramatically improving sentiment, which we're seeing. And once we get post-COVID, we'll be living within an environment of historic low interest rates. Borrowing money has never been cheaper than it has right now. Our rental yields are really strong in the right markets. There's a combination of factors there that will really lead into placing a lot of pressure on property values. And another one we're talking about before is supply. Listings are going to be extremely low within a market where there's a whole lot of demand from an affordability perspective. This will place pressure on growth, on rent and price values in good markets.
Which is why they would be seeing such a significant rise. I mean, looking around about 15% back end or through 2021, and that will really be the fact that you've got a demand that is outstripping the supply.
Certainly. Fundamentals are very strong there. Okay.
Right. So when we were speaking a little bit earlier about markets, that you want to be ensuring that you are investing in a suburb where you've got a significant cross-section of different types of employment. This slide really shows you which part of the economies have been severely impacted, partially impacted, and those which have not been impacted at all. In fact, a lot of those green sectors are in fact flourishing, if anything. So when you have a look at it, and I think probably the reason why the economic outlook has affected us emotionally in such a significant way is if you have a look at the sectors which have been heavily impacted by the COVID-19, they're things we love to do. We love to play sport. We love to go down to the pub and have a beer or listen to some music. We love to travel, in terms of pleasure and activity and things that really encompass our leisure and recreation. Those sectors have been very, very heavily impacted. And so again, if you're looking at a particular suburb whereby you're wanting to see some strong investment during this particular time, you want to ensure that you are in a suburb whereby you've got that green section, whereby you have a very good cross section of economic drivers in any particular suburb.
Yeah, no, exactly right. And like you said, life has changed as a result of COVID, so the impact feels huge. But from an economic standpoint, it's the minority of employment types that have been impacted. So we utilise SGS Economics, who form a part of our investment panel, very heavily to really analyse that. So we use them to determine where are the vulnerable areas of the nation, are our clients in areas of risk, and if we're looking to invest right now, of course, making sure we're avoiding these vulnerable areas. So a vulnerable area would be where the population is strongly reliant on income producing from retail, food and hospitality, and tourism-related service sectors. So the hardest hit areas, which SGS has identified, and we'll show you next, major cities and the inner suburbs of major cities and regional areas where they're reliant on tourism, including many of the regional areas which are unfortunately affected from the bushfires, which we currently recently went through. It seems like the distant past, which we're going through that traumatic issue on the economy, because we're faced with such a new one here. But some of these markets were heaving from that already, and then this has further exacerbated that impact.
Yeah, look, we sincerely hope that, particularly if you've got any of our clients out there that are in regional areas, that with the borders being closed, the holidays coming up, we hope to be able to see some local travel helping to boost those regional economies.
Yeah, exactly. So SGS look right across the nation, and they've done a study to analyse exactly where across the nation the most vulnerable sectors are. So this is where obviously there's a high percentage of people that are employed in these areas in those vulnerable sectors. So we need to drill right down further than a national level, and you look at things from a state and suburb perspective. You can see in Sydney, for example, the most vulnerable area of Sydney is the Sydney City LGA. You can imagine a lot of people in that area are employed in hospitality, student accommodation. These are the types of things that have been heavily impacted via COVID. So this would be the most vulnerable sector. But of course, it needs to be taken further and look at within individual suburbs and how and where people are employed, like the inner west, for example. A scary area in regards to rent and how things.
So, as we said, 65% of renters in Newtown are working in hospitality, and a significant others would be students.
Exactly right.
And here again, when you're looking up in Queensland, unfortunately, as wonderful a place as it is to travel, albeit we're not allowed to get there yet. Thank you, Mrs. Palaszczuk. As you can see, the Gold Coast, which really relies very heavily on tourism and good weather, is going to be heavily impacted by this. And hopefully, when they open up the borders again, you'll get some local tourism. Boost the economy.
There's obviously a big amount of money is spent from Australians travelling overseas. A lot of that will be internalised and made domestic over the next 12 months, we expect. Hopefully, Gold Coast will be looking to capture as much of that as possible, as will a lot of our areas of Australia that need it. So hopefully there's some positive news that can come from that moving forward. But currently, the Gold Coast economy is one we haven't been too bullish on before because of its reliance on tourism. As you can see here, it will be classified as a vulnerable area right now based on the reliance on that sector.
And that's one of the things which we're going to talk about a little later in this presentation is this is a great environment to be able to be looking to vendors who are motivated to negotiate in terms of price because of the market. So that is not something you want to run to. So if you're looking at somebody trying to give you extraordinary 10, 15% off a unit or something in the Gold Coast, one really wants to be fundamentally in an area that has a propensity for growth.
Exactly right. I think it's natural for investors, and seen it over the last decade here at Meridian, people will run to a discount. They're attracted to that because it looks good. 10% off a property, 15% off a property looks good, but that 10 or 15% discount is not going to mean much if the market moves backwards 10 or 15% over the next 12 months or 3 years, whatever the case might be. So it's really important to combine both, trying to negotiate as strong a discount as possible, but most importantly, within a market that's not vulnerable at all, within a market that's likely to perform and grow over the next 3, 5, 10 years. Yeah, exactly right.
Oh, sorry, mate. So, where is there an opportunity right now? What are we going to be able to look at that says this is a great investment in the current environment?
I think there's two types of investors. Some will just be sitting on the fence at the moment and seeing kind of how things play out and what's going on. Other investors will be looking forward, looking to take advantage of the time as an opportunity. So if we would look to invest in 2020, as always, market selection and negotiation is imperative, but certainly more than ever right now, like market selection and analysis really should be used to select a low risk market. So key factors are required, which I'll take you through next. This climate is ideal for negotiation. Use that to your advantage. That's certainly what we do here. So when it comes down to what are the fundamentals of a good property market? Well, the first is a suburb that's supported by a wide variety of employment sources, close to multiple CBDs with a very low unemployment rate. So we've always said it, but areas that are reliant on a single source of income that could be impacted from an event like COVID right now, what that can do is have a big impact on the performance of that property market. So to mitigate that risk, it's best to have the area supported by a diverse range of employment.
Absolutely. And as we mentioned before, you're wanting to be in an area where you have a very high percentage of owner occupiers. I mean, particularly down the line, you want to be able to be in an area where you've got a limited amount of rentable stock, and B, if you are wanting to liquidate down the line, you're wanting it to be in an area whereby an owner occupier is going to want to buy that, not an investor.
Yeah, definitely. Maximize your resale price by targeting an emotionally charge purchaser. But yeah, a lower risk will be in a market where the majority of the property is owned by homeowners. They're not selling in times of distress. They're sitting in the home and they're selling every other asset if they need to before they sell the home that they're living in. So a higher owner-occupier suburb.
And we're finding in those areas right now that the vacancy rates and the yields have had very little, if any, impact at the moment. And you will find that you're looking at those in established middle ring areas, really where there is limited amount of land, and you're looking at a vacancy rate that should be around about 3%.
Well, yeah, exactly right. These types of markets will tend to do better in regards to being quite stable in poor times, but they do very well in good times as well. So we also need to look at the future supply pipeline. So we not only want to target an established middle ring suburb where there's a lack of availability of land to actually build on, but the supply pipeline in regards to what's approved for construction and what's currently into construction that'll be coming into that market, that pipeline needs to have a low number. We don't want too much supply going into it.
And one cannot stress enough the significance of understanding what is coming. So we know from our economists what is the population growth going to be in this area? What are the development applications in this area? What would happen if all of those developments came to market at the same time? Are we looking at 10 people moving into 3 homes or 3 people moving into 10 homes? So to understand what the supply is of any given suburb is absolutely critical.
Yeah, numbers really need to be put behind all these fundamentals so far, and affordability is an extremely important one to monitor. We calculate that by looking at the percentage of household income spent on the average mortgage repayment. So really that number that should be below 25%. That means that a market is affordable. With these record low interest rates, it means that there's actually room for values to increase in these markets, and that's what we need to be targeting.
Room for growth. And when we saw Sydney and Melbourne hit the wall before all of this COVID-19, you were seeing affordability ratios of close to 40%. And that's when, boom, pricing stopped.
2017, Sydney hit that 40% level, and it was very clear the market needed to correct, and it did.
No room for growth.
18% in that time, the next 18 months. Okay, so what's a good market actually look like? Well, an area that we really like, the statistics are really strong behind, is Albany Creek in Brisbane. So what's it look like? It's up here in the north of Brisbane, 14 kilometres from the city. It's 6 kilometres from Chermside CBD, which is really the Parramatta of Brisbane. So the largest Westfields in the state is at Chermside. It's a big employment node, as well as the airport employment precinct.
It's the second biggest. The ports of Brisbane are the second biggest employment node in Queensland. So many jobs. In terms of the owner occupancy rate, we were talking earlier about trying to ensure that you're in a suburb whereby we've got the average that we have in Australia, which is 70% owner occupancy, 30% renter. As you can see from the slide, the owner occupancy rate in Albany Creek is 81%, which is off the charts. And as it says, you've got a very popular school catchment, which is why you will get a lot of renters going in there with very limited stock for them to choose from.
Yeah, it's certainly an established middle ring suburb. The vacancy rate at the moment is 3%. The reason we like a market like this is because it's extremely established. So you'll see soon the supply pipeline going into Albany Creek is very low, but you can't build above 3 stories high. So although we're quite close to CBDs here, it's still within a low-rise residential dominant type of suburb. This is what we like because it really reduces that risk of oversupply into the future.
And again, if you look at it, the type of socio-economic demographic in that area, you're looking at already close to 40%, 36% managers and professionals. You've got a low unemployment rate of 4.7%, which sits significantly lower than the national average. And if you look at the 3 most popular industries in Albany Creek, you're looking at hospitals, education and government administration. We can't see COVID-19 affecting any of those, and if anything, they are flourishing.
Yeah, healthcare and hospitals actually seen an increase, obviously, in employment. So these are areas, like I said, there that are flourishing or not being impacted. So these are the types of ways you can actually look at a property market to determine, is it not vulnerable? Is it got a low vulnerability? And this is the way, COVID or not, the way that we should look at a market to really reduce the risk to impacts of events like this. And when it comes down to affordability, it's got one of the strongest affordability calculations in Brisbane here. 23% of our income's being spent on mortgages. It's an indicator that there's a lot more room there for growth for current values compared to current incomes with current rates where they are.
Yep.
So this is the way we look at a market, and give you a live example of how we look at a market and what kind of fundamentals need to be in play and in line for us to continue the process, and then look to try and identify an opportunity within that market and then begin to negotiate on it.
So we've looked at we've looked at an opportunity with a vendor who is commercially minded, as that slide tends to say, and really in an area which has got zero distress selling going on in that particular market. The vendor is happy to give us, obviously, as we mentioned to you before, there has been a decline in listings, a decline in volume, and so the vendor is very keen for us to be able to try and secure five properties.
So that's right. We wouldn't see distress selling in a good market like this, because if you think about it, even if there was distress selling, there wouldn't be a substantial discount granted anyway, because you think about a good market, if something's advertised as a distress sale within that market, there's a lineup of buyers that are willing to negotiate and negotiate against each other to press that price up and get it back to the market level anyway. So we need to negotiate in a different way in this type of market, and that's why you identify a commercially minded vendor and understand what their priorities are and what they need. In this case here, it's a developer that's completing some townhouses here within this market. They've got 5 left that they basically need to sell, and volume is down right now. Like we said, volume certainly down right across the country. So how can we use that to our advantage? Well, we've approached them to purchase all of these properties in return for a reduced price and some rental certainty as well, just for the investor right now.
Very up-spec'd, beautifully finished townhouses. They are 3-bed, 2.5 bathroom, double lock-up, 2-car townhouses. Very much, as we mentioned before, 36% professionals and managers in that particular area. They are completing now. And when I say now, they will probably be completed over the next 6 to 8 weeks. They are brand new, which therefore allows you to have the full 6-year construction warranties, as well as to be able to claim a full year's tax depreciation. Price sort of between $475 and $495. What we have been able to negotiate for our investors is that the vendor will pay the stamp duty, which really is sort of around about $15,500.
Yep.
They've also put in a rental guarantee of $420 per week. Having said that, they're already fielding interest at $460 per week.
Yeah, we think although it's not necessarily needed in a market like this, vacancies are good, demand's really high from a rental perspective. It's just a safeguard. It's using this climate to our advantage in negotiating things like this. These aren't available to the local market, the local buyers. It's grouping together. 5 clients will access this type of opportunity, working together to do so, have the stamp paid, have some certainty there around a minimum rent guarantee there.
Yep.
Okay. So if this particular property is something that you'd like to get a bit more detail on and see whether or not it suits you, please make sure you fill in the question area below this screen here. You should be able to fill in and send through an inquiry.
And in fact, even if this property isn't something that you feel might be appropriate for you, we'd love to be able to have a chat, work out what your investment needs, wants, desires, budgets are. We'd love to be able to have a chat with you. So please fill in the box provided, and we will get back to you, in fact, with any questions or answers.
Yeah, there's a lot of data and information that we've covered here, so if anything wasn't clear or there's anything that you'd like to get some further information and clarity on, feel free to drop a question into the inquiry box below, and we'll get back to you as soon as possible.
Absolutely. Have a wonderful night. Thank you so much for your time. I hope you've enjoyed it. Take care.